Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending October 9, 2020. Thanks everybody, I'm Preston Brent, and thanks for tuning in. Remember, don't be a rat brain trader, you want to be the red striped zebra. This week's theme, no worries. Well, let's take a look at where we were this week or where we've come from. It's really actually a very strong week, not only in the United States, but all across all the major country exchanges. If we look at it, you can see in the upper left corner the Dow, S&P, NASDAQ, Russell, all in the green for the week. All of them very healthy gains. From the lower performer, the Dow, still coming in over 3% for the week. And then the strong performer, the Russell's been strong for the past several weeks, up 6.38%. The only one in the red year to date is the Russell, but just barely. It's come off the lows, doing really strong. And you can see in the upper right-hand corner, the U.S. valuations, the forward 12-month, 25.75. So, folks, that's still elevated. It's lower than the prior 12 by 31.98. Let's call it 32%. But that big difference there is due to the COVID and the crash and so forth. But it's still elevated. The forward 12-month is still elevated a pretty good bit. The dividend yield came down just a little bit with the S&P moving up. It's at 1.75%. And the 10-year Treasury moved up too, 77.5 basis points. The spread between the two, 97.5 basis points, just slightly under 1%. So there's still enough juice there to put money into the equity markets. You can see the VIX also came down 9.5% for the weeks, ending the week at 25. Sector performance, energy, surprise, surprise, had a strong week. I think part of it was the hurricanes coming through the Gulf into Louisiana again, so all the wells shut down there. That kind of tended to boost it. It had a good strong week coming in at 6.97%. Worst sector performance still finished in the green. Communication sector, XLC, came in at just 10 basis points to the positive. And then if you look at the annual sector performance, technology still leading the way at 32.44. And energy, of course, is still bringing up the rear at 46% to the downside. And then if we look at the world indexes, everybody was in the green. It's rare that we get everybody in the green for the week. China this past Friday is coming off a 7-day holiday. I wish we had a 7-day week trading holiday, but I couldn't imagine the gap open after 7 days of trading all the other markets. But anyway, it finished up for the week along with everybody else. But you could see in the green year to date, the only one still is China. And then if you look at the U.S. has now got 3 in the green. So the U.S. is outperforming everybody. All right, money is still flowing to the U.S., but it's starting to open up in emerging markets, a few other places, as the dollar potentially goes lower. And if we just take a look at the sound bites for the week, so let's just kind of go through them a little bit here. If we look at the market performance, as I said, the S&P had the best weekly gain this past week in 3 months, right? It was up a little over 3.8, almost 4% for the week. I think investors are growing more optimistic that a new fiscal stimulus is going to come through. Small cap, though, had a big, huge gain, as I said, over 6% for the week. And we're still moving the strong in small cap, which is a good sign for risk on money. Utilities and energy stocks kind of outperformed for the week. And, I think that's really a good sign as we head into the elections, the beginning of November. And of course, the market sentiment is very strong. Even though Trump got COVID, the sentiment is very strong on the consensus that his fast recovery on some of these new drugs, they were using this monoclonal antibodies into his system or into his body. So that's promising a substantial improvement in the way that they're treating these the COVID and the infection. So that dramatically improved the market sentiment. And I've told our members there's only 2 things that are going to really drive this market strong really quick. One is coming out with a fiscal stimulus, and the other is a vaccine. Those 2 are really going to move the markets into the fourth quarter. Okay. Now, the other thing I wanted to chat about a little bit is about market breadth thrust. All right. And a breadth thrust is just what it means. You've got market participation by all stocks or more stocks than just the FANGs and a few others. Okay. So this rally this past week, actually the first 10 days of October, broadened out And it really describes the breadth thrust, the way the market analysts use it and discuss it and record it from a stat standpoint, is that you take a 10-day period and they look at the advancing stocks um, in this 10-day period. We're coming into the Friday was October 9th. So if we look at the first 9 days, we've seen this happen where the advancers outnumbered the decliners 2 to 1 or greater. Doesn't happen very often. You would think it does, but it does not. It's only happened 29 times since 1990. And when you look at the stats, you can see that this signals a lot of buying pressure in the markets. And when this has occurred in the past, again, 29 times since 1990, 12 months higher, the markets have been higher on average 13%, 96% of the time. So that tends to bode well. Now, getting between now and 12 months from now, we can have a lot of volatility and a lot of movement, but it tends to show that as participation broadens out to other stocks, that is a good thing. That's one of the things we've been talking about here. I want to see more breadth action. In fact, we use the McClellan Summation Index in our weekly market watches every Sunday evening to look at the market breadth and participation, and it is a great indicator of markets getting ready to just roll over or move higher and continue to move higher. Okay. Now, if we look at the economic data for this past week, we had the ISM come in. They released several purchasing managers indexes for September, and they kind of met or just slightly exceeded consensus. So, again, a little bit of expansion, slow, but it's not going in the other direction. And the gauge of the service sector rose a lot more than people thought for the fourth straight month. So that's showing really good expansion as we come off these March 23rd lows, right? And then the weekly jobless claims, of course, it fell less than expected, but continuing claims fell sharply from 12 million to 11 million, all kind of bullish for the markets. And then, of course, if we look at the Treasury markets, you can see here the yield on the 10-year this week moved up higher. It hit its highest level in 4 months. Okay. And that is when we have, it looks like the long end of the curve, that would be like the 30-year bonds, right? They're going up on rising stimulus hopes because there is the fear of inflation. So the more stimulus you put out there, the higher the inflationary fear, so that tends to drive the further end of the curve higher. The shorter end of the curve really reacts more to the Fed action, which is kind of holding it down. So when you got the further end of the curve, the 30-year rising faster than the short end of the curve, that tends to create the yield curve. That would be the 2s over 10, the 2-year over the 10-year, or the 90-day over the 10-year expanded. That is good for banks. All right. So we're seeing some of that in the markets right now. In fact, high yield bonds are moving higher along with equities as an asset class anyway. Bonds are moving very strong. Okay. In fact, I was looking at the stats in Barron's this weekend. The longer end of the curve has just had a huge amount of inflows this past week in fixed income to the tune of about $25.9 billion. That's the second largest on record. Now, remember, as money goes deeper and deeper into the long end, as interest rates go higher, that's going to start to compete with equity markets for money. Okay. Remember, I said earlier the spread between the dividend yield and the 10-year interest rate it keeps getting tighter and tighter. And as long as it's positive, though, for the S&P, money continues to flow in there. But as the interest rates go higher, the spread between the dividend yield and the S&P and the interest rates on the 30-year or 10-year, they get tighter and tighter. That's going to move money more into the Treasury market. So we got to keep an eye on that. It's still wide enough now to channel money into the equity market, but at some point the competition for money at lower risk is going to outweigh, just coming in and buying a basket of stocks, right? Especially for fixed income funds and things like that. So that's a little bit about what we're seeing here. So what I'm going to do here is I'm going to move the screen over and I'm going to show you some of this broadening breadth here over the past 10 days. And I'm doing it, I'm going to do it with a 10-year or a 240-minute chart. So let me just get this over here on the screen. What I'm going to show you here is a ratio chart. But it's going to be the 240-minute chart, all right? And what you're going to see here, I'm going to wait for it to paint on the screen here, and then when you see it, you'll be able to see what I'm doing here. On this 10-year or this 240-minute chart, right at the bottom down here is right around October 1st, and as you can see, it's been moving higher. And in the numerator, I have RSP, which is an equal weight S&P. So it basically takes the S&P and weights all 500 stocks, 503 plus or 504 stocks in the S&P 500. It weights them equally. And when this is moving higher in relation to the S&P or the SPY, then that shows you that we're getting a broad thrust action in the markets. And we've seen on this 240-minute chart, for the first entire week and a half in October, we've seen that happen. All right. When it's coming down, that means if the markets are going higher, that means the S&P is being guided by a narrower and narrower group of stocks. So this is a good thing, guys. We want to see this happen. If we look at the E-minis, let's just go look at the E-mini futures here for a second. You can see here, let me just put it back on a daily chart so we can just bounce out a little bit. You can see the closing price here. You can see we're moving up. This is an impulse move here, which means it's a 3-leg. That means we can just keep right on moving up, take out the 35.87 all-time highs. Now we've cleared a key hurdle in the markets. What's that key hurdle? That is that prior pivot high right there. As well, the line is not very straight, but you get the idea. We've cleared that. We've come up in this area here. I would expect a little bit of a retest. If it holds and moves up, put your Pirates hat on, give yourself an eye patch, put that on and say, okay, right here, I want to go long, because that means we're probably going to come up and challenge that fairly quickly, okay, before the elections. Now, keep in mind, we got earnings kicking off. On Tuesday, the banks are going to be leading the way. We're going to get Citi, JP Morgan, okay? And then we're going to get on Wednesday, we're going to get Bank of America and Wells Fargo. And then Friday, we're getting Bank of New York, Citizens, and State Street. So we're getting big banks hitting this week. And if they do well, that's going to continue to just give the markets an impetus to go higher. All right. So that's kind of what I'm looking at here on this chart. Now, let me just get this off the screen here for a second. And if we come back and we look at the Russell, because the Russell has been on fire, all right? If we look at the Russell futures, I got to find it on my screen here. Here we go, right here. If we look at the Russell futures, look at this. And this goes to the last week of September. This has been on fire. We took out this major resistance point right here in this shaded zone here. Let me just step it out a little bit so that you guys can see. And let's just step it down. So you can see here we're slightly below the 2019 close, then the 2020 high that we had before the pandemic, and then the all-time high that was made in 2018 right up here. Again, this thing can run up, and I want to see this move higher. We're seeing more breadth in the market, more stark participation, and we're also seeing the fangs still hanging in there, but other stocks jumping in to take over, which is a good thing, right? So that is looking good here. And then if we come over here and we look at transports have been doing very strong. Transports are just moving up here, coming into a 2018 high price. I think transports have a way to go. That's a good thing. So we're seeing participation by, some of the majors out here like this. Now, if we come over here and we look at volatility and we look at the VIX, okay, notice we're still elevated, even though it's come in a little bit. Let me just widen it out a little bit. We're in the kind of a rose-colored area, so we're still elevated at 25. But we've worked our way down from the beginning of September when the VIX just, it shot up. And then a very unusual September where the markets were going down along with the VIX. That told me that pullback that we had in September was not anything serious. It was just more of a profit-taking move. And you wanted to buy the dip, right? And we talked about this with our members in our weekly Market Watch Sunday evening, and then some really good plays that we're currently running, trying to exploit some of that move. So this is what we're seeing. But now let's go at the back month vol futures. This is October and November. We're in the green. Okay, so that means that there is a normal contango in the vol futures October, November. And if we look at the November volatility futures, notice here it closed out the week at 29.05 for November. And if we look at December, you'll see here that it's 27.9. So we've got a backwardation between November and December. All right, that would, and of course this is normal because you can, the election, the vol has really been bid up out here in November higher than December. And that creates the backwardation in the back months. Although all the way out through November, if we look at October and November, that's in a normal contango environment. So this shows you, the nature of what we're looking at in volatility right now. And of course, if we look at the bond market, you can see here in bonds, we're down in a new target zone down here. I've said interest rates are probably going to go higher. As the stimulus goes out, interest rates go up in anticipation of inflation. The real yield, that would be the interest rates less inflation, is going higher. That would drive bonds lower, which is what we saw this past week, right? But we got this new target range for bonds from 177 to 170. And if we look at the 10-year interest rate, you're going to see here that we're bumping on heaven's door here. We're above, just trying to get up to that 78 basis point. If we take that out, we're going to be moving up higher. We're going to move to another range bracket here that would put us right around that level there. Okay, and I would expect that to happen. If that fiscal stimulus package does hit, interest rates are going to go higher, dollar's going to go lower, gold is probably going to go lower because money is going to want to go in and continue to go into the long end of the curve for bonds, and the real yield is going to go higher. All right, so just understand that for those of you that are trading the Treasury markets. If we look at the currency, here's the dollar. It had a pretty good down week, right? And I said we're still in a sell to rally. Now we busted a move through this tight congestion zone, but the fact that we could not hold the 50 EMA, the fact that we could not even find support at the 50 EMA, my target for the dollar is 91.06. Now the way to trade this, unless you've got ICE and you're paying 125 a month for the market data, which I think is really kind of absurd, then you're going to want to trade this with the euro. And the best way to trade this with the euro is in the European futures market, currency market euro. You want to be long, right? You can come in here and sell the 116 or 115 and buy the 114, 113, just do it as a bull put spread, or you can just do some ratio diagonals that we like to do and trade it back up to the 120 area. I think that's where the euro is going to be going. The British pound, the month of October, is going to be very choppy. I think the odds favor it to go higher, but be careful because if they don't get that Brexit deal done and it's a sloppy exit, then the British pound is subject to 1 or 2 day headline risk where it just tanks. And you don't want to be in the trade with nice profits when that happens. It's a binary event, so I would stay away from the British pound at this point in time. Once they solidify it, then I think the British pound could be a nice play. Right now, no. I think the best play is the euro long. So you want to be long the euro dollar or just long the euro from a future standpoint. And of course, if we look at gold, as I told you, had a nice up move on Friday. But we regained the 50 EMA, but until or unless we clear 1995, I'm not gonna be that interested in it. Remember, my original target in gold is up here around 2190, almost 2200. All right. If they do more stimulus and interest rates continue to go higher, and the dollar continues to go lower, but if interest rates are going higher, then trying to reflate the economy again, I just think gold is going to be running sideways for a while. I think gold longer term can be bullish, but near term is just going to be choppy as we sort this thing out. Now, if the Democratic party controls everything, then they're going to do a lot more spending, a lot more fiscal stimulus, and you could get a near-term boost in the equity markets just because they're going to expect them to spend money like drunken sailors. And should that happen, then you're going to see, I think gold is going to do fairly well. But we'll see. We'll see how this thing plays itself out. Just be careful with gold near term. I think it's going to be very choppy. Copper, we've been extremely bullish copper, right? We got bullish copper in early April as we're coming off these lows, and we've just played it. A lot of our members have played copper futures. It's been a home run trade. We traded it with Freeport McMoran. I think I gave this to you guys as a freebie here on these weekend roundups, just to say, you know, jump in on this when you can't lose. It's low hanging fruit. You want to double your money, do this right here. And that's what we've been doing. And it's just been a great trade, right? Playing the copper straight to the moon, right? Now, eventually, once you get up here, we're using options right now to hedge some of this upside move and lock in some profits. But I think it's still got more upside to go. Members, I'll go through more detail with you Sunday evening on our weekly market watch. Oil, where's oil? Well, we've had everything shut down for the past week. Energy and oil and gas has been good for the week, but oil has been kind of running sideways just a little bit. All right, but it's holding my area. I don't think oil is going to go below 35. I don't think it's going to come back up over 42 or 43 anytime soon. All right, nat gas. Well, I want this sucker to keep right on going. Okay, and we're in an Elliott wave 3. That means it's an impulse move. That means it can go higher. I'd like to see this go even higher and then roll back over again, but looks like we're not going to get any divergence. So that means we got to wait longer for it to roll over and then make new highs and then look for setting up shorts. Okay. So that's a real quick and dirty of where we are in the major markets. For members, I've got some really good dividend plays for you guys. I've got some industrial plays for you, and I got some thematic plays for you guys as the markets start to recover and we shift over to an industrial and cyclical kind of thing. If this increased breadth continues, I can see cyclicals and some industrials doing really well. All right. So these are some of the things we're going to review this Sunday. If you're not a member of our group, I highly encourage you to come in. We got trades that we're running that you guys should be able to manage, especially in the fly area that is unique on how we do it. We call them baby flies and super flies. They work out really well, high probability success, nice money. We're trading them right now on Amazon, and we're looking to and on the SPX. We're looking to enter them on the SPYs as well for smaller accounts. All right, everybody, have a great weekend. Members, I'll see you this Sunday evening. Take care, folks. Ciao now.